Hello everyone, welcome to May Market Review. Now today there will be 3 points that we'll be covering mainly. First is that equities and bonds have rebounded in May after April's fall. And secondly, dimensional funds actually in May outperformed the indexes mainly because small cap companies did better. Now this is actually a good reminder for us that in fact when the market falls, as we've seen in April, it is important to ride the volatility and stay invested to capture when the market rebounds. Now, finally, as a part of a monthly covering of major economies equity landscape, this month we'll be covering, doing a deep dive into India's equities landscape. Now, without further ado, I will just move on to the May performance. And right now, what we are seeing, as I mentioned, is that the market has rebounded and stocks and bonds have both done very well. In fact, the developed economy actually performed 4.5% to 5%. And if we look at the S&P 500 companies that tracks the US top 500 companies, it actually went up by 5%. And why is this so? Because inflation actually has shown pace of slowing down, and as a result, yield has actually come down. Now, as we know that when yield comes down, borrowing cost actually lowers, and companies actually benefit from these lower costs, and this actually is reflected in the market prices. Now, secondly, in fact, the first quarter results that was reported in US was actually very optimistic, and this also helped with boosting the S&P 500 market prices as well. Now, if we move on to look at the MSCI World IMI Index, which tracks the developed market, it actually went up by 4.5% as well. Now, aside from the contribution from the US companies, Europe is actually doing quite well as well. With regards to what I mentioned on the first quarter earnings in Europe, about 66% of the companies that reported their earnings has actually in fact beaten the market estimation, and as a result, Europe companies actually rallies as well. Now, finally, if we move on into the MSCI All Country World IMI Index, which rose about 4.1%, this tracks both the developed market and the emerging markets. And what we are seeing is that it is actually lower compared to the MSCI World and the S&P 500. Now, because the MSCI emerging market actually did not do as stellar compared to the developed market as, in this month. It actually went up about 0.6%. Now, this is because of the US yield, which actually came down, has a more global effect. And as a result, the MSCI emerging market actually went up slightly because of this news, and it rose about 0.6%. And next, if we look at the Bloomberg Global Aggregate Bond Index, as we all know, when yield comes down, price actually goes up. And right now, if you look at the Bloomberg Global Aggregate Bond Index this month, it actually went up about 0.9%. And this concludes the market index performance in May 2024. If we move on to the dimensional equity funds, as I mentioned at the start, that across all the equity funds, the dimensional actually outperformed the indexes. Now, first of all, we look at from the very left, you look at the Dimensional World Equity Fund. It's actually at 4.2%. Dimensional World Equity tracks both the developed and emerging market, and it outperformed the MSCI All Country World IMI Index by 0.1%. Now, if we look at the Global Core Equity Fund, which went up by 4.7%, again, this one tracks the developed market like the MSCI World Index, and it outperformed the index by 0.2%. And if we move on to the right-hand side and look at the global targeted value, it went up as high as 5% because it is more tilted towards small caps compared to its own dimensional equity peers. And the result actually, the dimensional global targeted value went up by 5%. And why is this so? Is because when the yield comes down, and we know that the borrowing cost comes down as well, small cap companies actually benefit more than the large caps Why is this so? Because the small cap companies in general have a larger ratio of debt. And because of that, when debt comes down, it actually, small cap company actually benefited more compared to the large cap companies. Now, of all these equity funds, the one that actually shine most is actually the dimensional emerging market large cap core equity fund, which has risen by about 2.5%. If we compare to the MSCI emerging market, which only rose by about 0.6%, this actually outperformed 2 times as much compared to the index. And this actually shows that the emerging market small cap premium is actually showing. And next, without any delay, we go into the India equity landscape. And first of all, I want to just emphasize the importance of India's equity landscape. Why are we covering this? Now, if you look at the weight of the emerging market, MSCI emerging market in India versus China, if you remember in my April market review, I mentioned that for the past 20 plus years, China has been the dominant weight in the MSCI emerging market, and also one of the main drivers for having a higher weight in the MSCI All Country World IMI index as well. But in recent years, there's one country that is catching up, which is India. And right now, India's weight is 18% compared to China, which is 27%. And in fact, one day, it could be that India's weight could be as high as China or even more. And therefore, it is important for us to know to understand this equity landscape, because we have a significant exposure in the MSCI emerging market, as well as the index, the dimensional emerging large cap core as well. And without further ado, let's go into the sections that we will be talking about that contributes to the equity landscape in India. First, the foreign direct investment, short form FDI, which is the inflow of investments that foreign companies put into India, and therefore contribute to the Indian economy, and as well as the India's equity market as well, through technology spillover, as well as increase of skills. Now, secondly, the demographic dividend. Now, what the demographic dividend means is that in India, there is a large workforce that are younger compared relative to other companies, and the ratio of the young labor force to the older labor force is actually higher. And historically, countries that have this demographic dividend tends to see their equity market actually do well over time. And this is what why is this so? Is because, so in fact, when there's a younger labor force, it actually helps to reduce the overhead labor cost for companies, and therefore helps with their bottom line earnings. Now, for the third point, financialization of household savings. So what this means is actually that historically in India, the household savings tends to be more into bank deposits. And right now what we are seeing is that there is a financialization of this savings, where the Indians actually put less into their bank deposits and invest into the equity in the Indian equity market. And what in fact historically also in countries like US, where there is this kind of transition in US, which is in the early 1980s, when the 401k plan actually just implemented, we are seeing that a lot of Americans actually put more money into the US equity market, and this helps to increase the liquidity and bring up the valuation within the equity market itself. And therefore, this is what we could be seeing in India as well. Now, on the fourth point, the artificial intelligence, we know that the AI wave is coming for the past 2 years. And what does this mean to a country that has a high, that relies quite heavily on the IT sector? And these, what we will be also looking at the opportunities and the threats as well. Now, finally, we do know that in the start of this month, there was election going on, and there was quite a bit of volatility in the market, and we'll be looking at the India's election because this is one of the biggest things that investors are looking at as well, and here we will be trying to understand more about it. Now, going into the first point, the foreign direct investments, as you can see from this chart, the foreign direct investments in India from 2014 to 2023 has been rising. Now, although you can see that there's a drop after reaching a peak of 85 billion US dollars in 2022, in 2023 there was a fall from 85 to 71 billion US dollars. Now, this is not specifically to India. In fact, in the emerging market in 2023, there was a fall in FDI of 9% within the region due to the higher interest rate that central banks have been hiking. Now, so aside from that, we can see that the trend has been upward for the India's foreign direct investment. And why is this so? We all know that there is a tension between the Western worlds and Russia and China. And in fact, especially US and China, a lot of these US companies are intending to have a China plus one strategy. And therefore, companies like Amazon, Google, Apple, and their suppliers are actually looking to move into India. And therefore, there was a rise in foreign direct investments. So in order to relocate their supply chain. Now, if we go to the next slide. Okay, so what we are looking here is to explain why the foreign direct investments actually helps with the Indian companies in general. And what we are looking here is the total factor productivity correlation with the foreign direct investments. Now, historically, there are a lot of researchers that shows that FDI, foreign direct investments, actually have a contribution to total factor productivity. Now, what is total factor productivity? Like the word itself, it is basically a measurement of the productivity within the India country and the companies itself. Things like technology, skills, and business management practice, best business management practice actually help with the productivity. And when FDI increases, there is a spillover of all these companies' technology, skills, and the best practices to local companies. And over time, you can see, for example, this chart, which measures China's total factor productivity from 1984 to 1999 has been increasing when foreign direct investment is increasing. If we move on to the next slide, of all the sectors, one of the most talked about sectors that is the IT sectors or the services sector, because of all the big techs moving into India. However, the low-hanging fruit is in fact the manufacturing sector. Well, why do I say so? Now, if you look at the manufacturing value added in 2022 as a percentage of the GDP across India's neighboring countries, India actually has a lower percentage of 13%. Now, if we move on to the next slide, you can see that the merchandise exports by country in 2020, if we compare, for example, these four countries, India is actually the lowest. Now, in fact, between Vietnam and India, Vietnam actually hires about 12 million people in the manufacturing sector, but their global share of merchandise export is actually higher than India, while India actually hires about 35 billion. Now, what does this say? What does this tell us? Now, very easily, India's manufacturing is not that productive because it is a labor-intensive sector. And in fact, by introducing just a little of a higher technology, better skills, and better management practices, we are able to capture this whole low-hanging fruit and increase the productivity exponentially. Now, if you move on to the next slide. Now, but the question is also, will the upward trend of the foreign direct investments actually continue to increase? Now, let's look at the evidence. First of all, Apple and its suppliers, in specific Foxconn, actually plan to manufacture over 50 million iPhones annually in India within the next 2 to 3 years. This would potentially increase their production of global iPhone in India to a quarter by the end of the decade. Now, on the other hand, major technology investments like Google and Amazon are expanding their investments in India. And in fact, Amazon is planning to invest $26 billion by 2030. Now, on the government side, the government of India actually aims to attract at least 1 billion in foreign direct investments for the next 5 years on average. And this would surpass the previous average of 70 billion that we saw in the chart just now. And officials expect to approach this target in this current year, fiscal year, driven by tech companies' investment and proactive government targets. Now, the question is the government actually putting the money where their mouth is? Now, if we move on to the next slide, in fact, they have been introducing reforms like tax cuts to attract more FDIs. Now, the more important thing is their capital expenditure on both infrastructure and manufacturing. And in fact, they forecast that by the fiscal year of 2024, their budget estimate is about 10 trillion rupees. And that increase would actually help to increase the amount of infrastructure and manufacturing sector within India, and therefore helps to attract more companies to invest in a country where the logistics is more developed and the manufacturing sector is better. So hence, to conclude the foreign direct investments, that we are seeing that there will be more inflows coming into India, and within India, it's likely that there will be a good amount of technology spillover, increase of skill, as well as a business management processes of learning. And this is very helpful, especially to a country where there is a higher ratio of a young labor workforce to the old labor workforce. Now, in fact, this is the next point that we'll be talking about, which is the demographic dividend. And point 2. Now, basically, what I mentioned just now is exactly what a demographic dividend is. The median age in India is about 28 years old, compared to China and US, which is 38.4 years old, and to the more extreme, it is in Japan is about almost 50 years old. Now, if you look at the Japan and India's population pyramid, you can see that the ratio of Japan, where the older workforce to the younger workforce in population in general, is actually quite high compared to India. And this means that India has a very huge supply of labor force in at least the next decades or so. And this would actually bring down the labor costs, and therefore helps with companies' bottom line earnings. And that's one of the things why we call it the demographic dividend. Now, if you move on to the next slide, you can see also that there's a lot of untapped potential for educated Indians, especially when you have such a huge labor force, and education is one of the most important things that India emphasizes on. And if you look at especially in the urban areas, and if you don't mind, let me just if you look at the urban areas, in the people on average that has a education of graduate and above is actually 21.7%. And this is actually quite a high ratio for a developing country. And on top of that, just to pull out some numbers, there are only 33% of women in the labor workforce that is being hired, which means there's a lot of untapped potential within the women labor workforce as well. And if India is able to leverage on this advantage, it would actually greatly benefit not just the economy, but companies themselves by hiring all these educated or female labor workforce. Now next, let's move on to the next slide, and you can see, despite what I mentioned just now, the demographic dividend, there is kind of a race against time because it would not last forever. And one of the challenges is that the large working age population, they need productive jobs as the economy shifts from agriculture to services. And it's also important that this transition actually need to create paying jobs for people with less education, and especially when China focuses less on manufacturing. In other words, as China move on from manufacturing to a higher tech, like tech-like services, and India is actually taking over, quote unquote, as a factory of the world. It is important that there needs to be sufficient jobs to hire all these extra labor force, or else there might be a social economic issue that we will be facing. Now, as well as the second point, we are also seeing some recent setbacks in terms of in the manufacturing sector. Why is that so? Because recently there is actually the India actually withdrew from the regional comprehensive economic partnership, and there is a shift in the Make in India motto, which in fact, when you say I'm Make in India, is actually to manufacturing within India, but this initiative has moved on to Make for India, which is focusing on import substitution. And this actually means that there's less emphasis on the manufacturing sector by the government, which might not be very helpful in the long run. And recommendations for this is that it's better for include that attracting formal sector firms to labor-intensive manufacturing. This would in fact help to improve labor productivity and enhance female workforce participations. Now, on the final point, the importance of structural reforms and future risks. So, what this means is basically that the structural reforms are extremely crucial to unlock the demographic dividend and resulting in a sustainable growth, and is essential for meeting the developments of goals and avoiding fiscal and social challenges that I mentioned just now from the aging population and without even being able to capture this demographic dividend at the first place. So therefore, these government reforms is extremely important. Now, if we go on to the next point, financialization of household savings. Again, let me just explain that this is basically household savings has, instead of putting more money into their bank deposit, now Indians are actually investing more in the equity market. And this historically has helped many countries like US during the 1980s, where US citizens has been investing more into the equity, resulting in better liquidity within the equity market and a higher valuation for equity market prices. Now, if you go to the next slide, you can see that, in fact, India's mutual funds to gross savings ratio has been increasing over the years, reaching a peak of financial year 2022. In fact, within financial year 2022 and financial year 2023, about March, the domestic mutual funds holdings in India has actually reached an all-time high. And if we go to the next slide, what we want to understand what is driving the investors' behavior shift into the equity market. Now, first of all, there's an increase in financial literacy, and they are now, a lot of Indians, especially the young ones, are aware of investment benefits leading to the changes in their saving patterns. Now, as well as the next point, the technological advancement, rise of digital platforms is actually giving Indians more accessibility and convenience to enter the India equity market. Now, if we go to the next point, on top of that, there are more regulatory support from the government and increase of market confidence with the equity market. Regulatory support and pro-investors policies have increased market confidence and trust among investors. And of course, the strong performance of Indian equity market, like all markets, when the market is doing well, it will bring in more new investors that are seeking higher returns compared to the traditional savings instruments. More importantly, as I mentioned, the financialization of savings has actually resulted in a robust domestic inflows into Indian equities and provide a very stable foundation for growth despite the global uncertainties. And finally, the increase in retail participation, which I mentioned it was at all-time high, is diversifying the investors' base and reducing reliance on foreign institutional investors, which historically India equity market has been relying on, and adding more resilience to the market, resulting in a more strong and resilient and robust Indian equity market. If we move on to the artificial intelligence, AI, we now look into the threats and opportunities that India companies and the market is able to capture. Going to the next slide first, two of the largest IT service sector in India is Infosys and Tata Consulting Services. And these two provide a lot of IT services, which include coding and data processing capabilities. Now, it is not surprising that the AI, the first threat that companies that will face with the AI would be the IT sector. And if we look into the IT sector, although it's just employing 5 million people, it is contributing a 7% to the GDP. And if AI, in fact, there's research showing that if AI actually is able to take over and replace all these companies, it might affect India's GDP for about 0.5% to 1% annually, which is quite substantial. And this means that it could affect growth and of course affect the Indian equity market, which in this case we use the Nifty 50 index as a proxy. Now, of course, on top of that, when you are replacing these companies, you are threatening the jobs of the people that's working within these companies. And the first that is most likely to reduce to see their jobs getting threatened would be the most basic of the IT call centers, and which in turn means that these firms, they need to be able to capitalize on this AI opportunity. And in fact, the AI opportunities can help the companies like Infosys and Tata Consulting Services to reduce costs and attract new clients for Indian IT firms. And there are additional attractions for the Indian company to adopt this AI technology and integrate into their system. And in fact, there is an additional attraction for these Indian companies aside from just integrating the AI system to protect their sector, and that is the Global Capability Centers. So now, what are the Global Capability Centers, GCCs? These are centers that are established by foreign companies like Amazon, Google, and Rakuten in India. And in fact, instead of outsourcing to companies like Infosys and TCS, they are using these global capability centers for their Indian IT services globally. And this actually reduced the revenue for Indian companies like Infosys. And by integrating the AI and adopting this AI technology, they might be able to win back some of this business from these companies, and they, in fact, help them to achieve cost efficiency and offer better solutions to reduce the impact of the global capability centers. AI wave is not just an opportunity to their development for the Indian IT services sector, but also a threat to their self-preservation. Now, the final point we want to touch about is the impact of the election on India's economy and market. Now, first of all, let me just give a brief idea what has been going on in the Indian market. Modi's party, BJP, has actually was expected to have a landslide win and gain a majority of more than 272 seats within the parliament. And gaining this majority would actually give them more ease to implement the reforms that they want to, for example, infrastructure and manufacturing spending that I mentioned, up to 10 trillion by financial year 2024. 10 trillion rupees, I mean. And but the results was in fact not that rosy. They won only 240 seats. And in order to capture the majority, they have to form a coalition, and the coalition National Democratic Alliance Party, NDA, there was a worry that the coalition would impede some of the reforms like infrastructure and manufacturing spendings that the Modi administration wants to implement. Now, as a result, when the election result came out, the market in fact fell by around 6%. And in companies that are sensitive to these reforms that I mentioned, infrastructure and manufacturing, companies like Larsen and Toubro, one of the largest engineering companies, have fell on the same day by double of the Nifty 50. It fell by 12%. And this shows the sensitivity of these companies that are dependent on these reforms. Now, that said, on the very next day, the investor confidence and economic fundamentals actually triumph. And as a result, because of the Indians' resilient economic fundamentals, the market actually rebounded the very next day. And in fact, experts from Goldman Sachs have actually mentioned that even before Modi's administration, there are various shades of coalition within the Indian government. And historically, it has not shown evidence that they will reverse or U-turn these business-friendly policies, even though the government is forming a coalition. Hence, the foreign direct investments, there are a lot of evidence that the reforms that will be implemented will continue to be so, and it attract more foreign direct investments. Now, in conclusion, just to 3 points. At the very start, we mentioned that the global market has rebounded, and the MSCI All Country World is seeing a 4.1% rise thanks to the developed markets' favorable corporate earnings and easing of inflation. And the second point, on India's equity landscape, India is showing a lot of growth potential. And it is supported by the increasing of the foreign direct investments, the demographic dividend, and the financialization of household savings, despite the recent volatility that we are seeing in India. And in order to capture these opportunities, stay diversified to capitalize on the global recovery and India's growth, and balancing the investments across emerging markets like India and developed markets can optimize returns and mitigate risk effectively. Now, I'll pass my time to my colleague Joyce, who will be talking about the market debrief. Thank you.
Thank you, Sushong, for the very comprehensive market review. My name is Joyce, Client Advisor at Provident, and today I'll be giving you a market debrief. So in my last market debrief, I discussed the importance of asset allocations and also the benefits of staying invested. So today, I want to talk more about why are we emphasizing so much about managing your emotions and also avoiding being affected by the news and the media, because there is a cost to reacting. So looking at this chart, the performance of the S&P 500 index returned about 10.7% per annum since 1990. And however, if an investor had left the market due to fear and missed the 5 best days of recovery, his returns would have dropped to about 9.18%. So this continues to drop to only 5.55% if he had missed the top 25 best days. Hence, trying to go in and out of the market adds not only additional stress, but also increases the risk an investor is taking. So a common question that we get is whether it is a good time to invest now. So well, this chart shows the average annualized performance of the S&P 500 over the next 1 year, 3 years, and 5 years after they have fallen by more than 10%, which are typically a good opportunities to invest since the prices are lower. So now, let's also look at the same chart of returns. If you invest at new market highs, the average returns after 1 year, 3 years, and 5 years was above 10% as well. And this is why it is impossible to time the best return based on the historical past performance. Today, I've come to the end of the market debrief. So if you have any questions regarding what we have discussed earlier or the chart, please reach out to us. Thank you.